This recording we're going to take a look at the Summer 18 question 3, focusing on a number of standards including IS36 impairment, IS16 and IS20 around property, plant and equipment and grants, and the relatively new revenue recognition standard Ifrs 15. So both the technical accounting standards asked here, issue 1 and issue 2, were poorly answered by students in Summer 18. So it's a key learning point. You need to know your technical standards. You'll get about 7 or 8 in a question 1. And you'll get 4 or 5 in each of the question 3, question 4, which are the optional questions here. So I assume you've read through it. First question we're looking at, and key to underline again, what are you asked to do? First thing you're asked to do is write a memo. Very basic, you'll write a memo. All it is you're saying to Board of Directors of Morecambe from A accountant, and you're going to say re-accounting issues. That's all it is. To get your marks, there will be presentation marks going, and all you're going to write then is the subheading issue 1, and you address issue 1 and so on, like you're answering any normal exam paper. So make sure presentation is high on your agenda for all questions in F4, because there will be presentation marks going. So we're given information here about the purchase of all the shares in Jerome Limited for 8 million. At the end of 2016, and you're told then what the fair value of net assets was at the date of acquisition. Roll forward a year and you're given information about the carrying value of net assets, but you're also told what the recoverable amount is. And your first requirement here is calculate the impairment loss. So this is specifically the impairment of a CGU, a cash generating unit. So IS36, which you'll jot down to show the examiner you know the standard. That deals with two things, the impairment of an individual asset and the impairment of a CGU. Similar approach to each one. You compare net assets of CGU, which is often called the carrying value. Compare that to the recoverable amount. Now in this question they've told you what the recoverable amount is. It was 6 million. In other ones you'd have to figure it out. The recoverable amount, just for other questions, it's the higher of value in use and fair value less cost to sell. So just make sure you know that and you have that down for your summary sheet for IS36. There's two ways you can recover value from an asset or a group of assets. Either sell them, which is the fair value less cost to sell, or by keeping them, which is the value in use. Here we're told it directly. Our carrying value, this is for the cash generating unit. In this instance is 7 million, which we're given here. Now this is where students went wrong. There's also goodwill in here, because you purchased shares for Jerome a year earlier at 8 million, where the net assets, the fair value net assets was only 7.2. So there was goodwill at acquisition of 800,000. And then there was other assets, which were given in the question, of 7 million. So that's where a lot of students went wrong. Always ask yourself, why am I told about the 8 million and the 7.2 million acquisition? You know in a cash generating unit there can be goodwill as well. So we'll just split out those other assets to make it easier. PPE 5.2. You had development expenditure, which is an intangible asset, which is 800. And then you had net current assets, which are your trade receivables, your inventory, etc., your working capital, 1 million. So overall, the carrying value was 7.8, and the recoverable amount was 6 million. So straight away we know this is an impairment. At the end of 2017, this cash generating unit is overstated. So you have an impairment loss of 1.8 million. So that's your first one for 3 marks. Where students went wrong there was they missed out on the whole idea of the goodwill attached to the cash generating unit. So now what we're told is to calculate the carrying values of the assets after the allocation of the impairment loss. So again, now we're getting to the more specific problem, because calculating the impairment loss, such as we've done there, that's the same for an individual asset as it is for a group of assets. You look at them as a single figure. The problem is now for B is how do we allocate it? So the allocation of the impairment loss. And there's specific rules in IAS 36. You don't need to reference the paragraph, but the rules are you write off goodwill first, then allocate pro rata over rest of assets. So there's certain rules. The first thing is you're going to write off all of goodwill. So that is our 800 gone straight away. You're going to write off your goodwill. That's the rule under IAS 36. Then after that, that means we have $1 million left to pro rata because the impairment loss is 1.8 million. So you have 1 million left and you allocate this pro rata. Now be careful, current assets do not fall under IAS 36. So these, although they are in the calculation of your cash generating unit and the carrying value, when you go to your allocation, you're only going to be allocating over PP, which is 5.2 million, and your development expenditure, which is 800. So that means you're going to be allocating it over 6 million of the assets. That's quite a tricky one. Net current assets are not included there. So your next step then is to figure out, well, pro rata means what percentage of PP is that? 86. And the other one then must be 13.3. That is the relationship in which you allocate your impairment loss. So here, PP is going to get 1 million times 0.86%, which is 866. 800, we'll just round that to 867. And then this is going to be 133. So your allocation to PP and to development expenditure. You're not going to lose for rounding there. So that's the full allocation of 1 million. That's your step of how you go about it. Now there is one other important rule we'll get to in a second. So that's your first step. So that would mean our goodwill becomes nil because we've it all written off. Our PP will become 52 minus 867. So that will mean if we do this write-off, it'll become 52 should I say, minus 867. Now what you have to watch here, and this is the important caveat in IAS 36 with the exam level, is the recoverable amount of the individual PP is 4.5 million. So what that means is, although you've said it should be written down to 4.3, there's a limit. It cannot be written down more than its recoverable amount. Likewise, the net realizable value of non-current assets or net current assets is 1 million. That's why you can't allocate any to that. It's already at its lowest amount. So that means the max you can write down there is down to 4.5 million. So actually the allocation you're going to give there is limited to 700. You tried to give 867, which would have been fine, only for this piece of information. You cannot write it down more than its individual recovery amount. So if you're ever given that in the question, it's there for a reason. So that means your development expenditure here will actually be going to get written down 800 minus, you've already written 700 of the thing down. 700 of the million is written down, so you're going to take off the other 300, which leaves you with 500 there. So although this was our initial allocation, our revised allocation now is 700, because we cannot write it down more than the 4.5 million, and that leaves us with 300 written down there. So there is a couple of structured steps, but this is quite an examiner favourite, so make sure you go back to your IAS 36 notes and understand the allocation process, which is very important as part of IAS 36. And then your net current assets remain 1 million, because they can't be written down anymore. And that gives you your 6 million, which is your recoverable amount. So it's important that give the examiner exactly what they asked. They wanted the carrying value of the assets. They have the carrying value now of the 4 separate assets. 8 marks. And your final one then, of course, then is your journal entries. Your journal entries should hopefully be straightforward from that. You're going to debit your impairment loss, 100. Right, so you can do 100,000. You just to put the 1,000 signify here. So it shouldn't be 100, apologies, it's 1.8 million. I'm mixing it up. So it's 1.8 million debit impairment loss. You're then going to credit goodwill, the first amount. You wiped out goodwill. You got rid of the full 800. You're going to credit PPE. You can only credit that 700. to bring it from its 5.2 down to its minimum of 4.5. And then you credit your development expenditure, the last one, which in this case is 300. And that is your full marks, your journal entries. So make sure you go back. IAS 36 impairment is quite popular, and there is another screencast on DoubleExit looking at a similar type question. The initial rules calculating the impairment loss are similar enough to individual assets. It's the part B, the allocation of that loss, where there's some quite tricky rules that you need to make sure you summarize in a nice cheat sheet. So if we just look at the examiner feedback for that, generally poorly answered. Significant number of candidates did not show how they arrived at the carrying values. So didn't show your workings. Struggled to allocate the impairment correctly. And that's the key point where there's a lot of rules. They forgot the goodwill rule. They forgot the pro rata rule. And subsequent journals were generally well answered, but they had the wrong figures. So you will get your marks, even if you bring down the wrong figures. But the point is students couldn't do IAS 36, a very commonly asked question. The next one is another two standards that are quite common, which is your IAS 16 and your IAS 20, property, plant and equipment and a grant. So in this instance, you bought a piece of plant for $1 million in June, and it was depreciated over 9 years. But after that, in August, 2 months later, you got 45% of the plant's cost back in a grant. Full year depreciation of your purchase. Now just be careful, they do not ask you for journals here. They want the relevant extracts from the financial statements. That means what items are going to go into the P&L, what items are going to go into the statement of financial position. Students are weak on that. Be careful of what exactly you're asked in the exam. So if we work down through it, we'll give the journals just because it's easier to follow through, and then we'll work through how we account for each. So in June, you debited plant, debited PPE, and you credit your bank. Fairly straightforward. 1 million and 1 million. So nothing unusual there, but again you need to know this because this will be impacting the extracts of the financial statements. Then comes along in August, so I'll write there that's your June. In August then, you're going to debit bank because you got 450,000 in. So just break it down to manageable chunks, and you're going to credit deferred income. Now, there are two acceptable approaches for your grant. You can either credit deferred income and treat them separately, or you can net them off against the cost of the asset. Either one was acceptable here. We're showing the one consistent with the solution. So in this case, we're creating deferred income of 450. Alternatively, you could have netted the 450 off against your property, plant and equipment, in which case you'd have a different depreciation each year. Then, that's in August. And at the year end then, you have two things to do. First thing is you have to charge depreciation. So you're going to debit depreciation in the P&L, and you're going to credit accumulated depreciation. Now just be careful here. It's a 9-year life, but the residual value is 100,000. So it's going to be 900,000, which is cost minus residual value divided by 9. So a nice even 100,000. And that's the same for your accumulated depreciation. And the other thing at year end, as well as charging depreciation, you must release, or what we call release some of the deferred income. So you're going to debit deferred income, and you're going to credit the P&L, other income. You can call it other income, or you can put it as a credit to the expense line. Depends if it's material or not. So the logic is here, you're not allowed to recognize this grant income straight away. You're going to recognize it over the useful life of the plant, which is 9 years. You can either do that by reducing the plant cost by 450 and therefore having a lower depreciation amount each year, or the way we're going about it is you're going to release 50, which is 1/9 of the grant each year, into the accounts. Now, you weren't asked the debits and credits, but you really had to know them if you wanted to get your full marks. So now we're thinking, we now need to look at the extracts of financial statements. By this, what they're essentially looking for is, you're looking at the SOPL for year ended 31st of the 12th, 2017. So all they're looking for is just put a heading, something like that, And what they want to see is what's your extracts. You're going to have one, you're going to have other income. Here it's going to show a 50, which is the release of the grant. And then you're going to have depreciation expense, and you're going to show that as a minus 100. And that's all you're getting for that's what we call an extract from the P&L. That's all you have to show. Depreciation expense and other income. So just be careful about the reading of that. In your SOFP, as at the 31st of the 12th, 2017, similar logic, we now want to see, well, what goes in each one. Well, we know we have a non-current asset. You have PP cost and PP accumulated depreciation. This will be 1 million. So we assume we just have the thousands here. And you have accumulated depreciation of 100. So that means your net book value there is 900 in your non-current asset. So all we're looking for is these specific line items that are there. You come down along then. What else will you have? You don't have any other impact on your assets, but you do have one or two things here. You will have your non-current liabilities, and you will have your current liabilities. Your current liabilities, you will have a bank position of 550. Now where does that come from? Well, you paid $1 million out of the bank and you got 450 in. So your net credit, we're assuming an overdraft of 550. Because again, we don't assume anything else is in the bank account. The other current liability you have, it will be deferred income. So similar to a finance type lease, this deferred income, which is total deferred income left, is 450 minus 50 that has been released. You have 400 of that grant still to be released. But 50 of that will be released next year. So that will be a current liability. And the remaining 7 years will be a non-current liability, which is 350. So you need to split it like that to show the examiner you understand how it's been presented. So that is next year's one, which is, we'll just say that's 1 year, and that is the other 7 years to be released over the subsequent years. That's the way it should be presented in the financial statements. So again, a slightly different requirement than you might be used to. You still need to know your journal entries. What was asked here is the extracts of financial statements. So reading the examiner feedback for that one. Similar to issue part B of question 1, candidates did not present their answer in the required format. They want to see account extracts. Right, so you need to make sure, depending on what way they want it, make sure you give it back to them. Lack of familiarity with statements, financial position. Given that most candidates were not familiar with the contents of the relevant account extract, typically incomplete. So you're losing marks very quickly if you cannot do this. So expect, if it's answered poorly before, expect it to be re-examined again. And your final requirement then for your question was to do with Ifrs 15, which is a relatively new standard replacing IAS 18 and IAS 11. They're telling you, discuss the steps that a company should apply to recognise revenue in accordance with the core principle. This is the first year it's been examined, so it's quite basic. You only have to give the 5 steps that IFRS goes through. So you can see your presentation mark for 1, which is the memo. I'll just show you the solution for the 5 steps. Quite a basic answer. So you need to know your material. Just go 89 here. So all that was required here is list out the 5 steps. You don't need to give the detailed paragraphs of each one, but if you could identify the contracts, identify the performance obligations, determine the transaction price, allocate that price to each obligation, and then recognize revenue as required, that will be more sufficient. Maybe a 1 or 2 line explainer. That could be a 200% solution. So don't be too put off by that. But because IFRS 15 was new last year, it was only examined in a more narrative format. As we go forward, you're going to have more numerical examples and requirements put in. So that looked at summary 18, question 3, particularly poor responses for students in terms of IAS 36 and dealing with grants as well. watch for the memo when you're asked to do it, and watch when they're asked to present either carrying values, or you might be asked to present extracts from the financial statements. Don't always assume it's just journal entries that are required, and that caught out students in that particular sitting.